Hey guys, welcome to my channel. My name is Mufaro. Today's video is about how to do group statements using the analysis method. Now, this is a very basic method. However, what I have discovered through my journey with group statements is that often with the group statements question, there's always a lot of easy marks. I understand this is an extremely basic example. However, I feel that especially when it comes to exams, they're going to sneak in these undergraduate easy marks that we sometimes actually easily forget how to, especially how to do the consolidated financial statement. Sometimes I find that I've actually forgotten how you do the consolidated statement of changes in equity, how you do the consolidated statement of changes, the consolidated statement of comprehensive income, as well as the consolidated statement of financial position. Wow, it's quite a mouthful. So in today's example, I just want to show you guys how to do the analysis method. I know most people who study with UNISA, they don't really prefer the analysis method, but I think that the analysis method is so much easier and it really does not take that much time. And I can't really exactly comprehend how people use the other method, because for me, the way I was taught, we just do the analysis method. So before we go any further, let me go straight into my example. So this is an example I made out of my own head. Parent purchased an 80% interest in sub for 140,000 rand on the 1st of January 2018. At acquisition date, the share capital and retained earnings of sub was 100,000 and 50,000 respectively. The opening balances on 1 January 2019 were, as you guys can see, that because the question is gonna be doing the consolidation journals and the consolidated statement of financial statements at the consolidated financial statements at the end of January 2019, which is going to be December. So both parent and sub have got a year that is running from January to December. And then parent's share capital was 500,000 and it did not change. Sub sold inventory to P during the year at 20% on cost. Inventory sales between sub and parent were 90,000 rand. The closing inventory in P from S was 50,000 rand at year end, and non-controlling interest is measured at fair value. Assume the fair value of NCI, not at year end, sorry about that. Assume the fair value of NCI at acquisition was 40,000 rand. Sub declared and paid dividends of 20,000 rand at year end, and parent declared and paid dividends of 30,000 rand at year end. And this is actually something I always forget, and it's actually an easy mark when it comes to how do you actually treat that in your consolidated statement of changes in equity. So yeah, I just made this example because group statements can be very overwhelming because they're so long, but they're actually quite easy when you understand what is actually going on. And the question is, perform the consolidation journals at year end as well as consolidated financial statements. Welcome back, guys. So as you can see, I have my analysis here. This is the analysis of sub, and in my example I said we're acquiring 80% of sub. So the first step is you analyze what happened at acquisition. This is why all of this is essentially going to be going to the second column, which is at acquisition. The share capital at acquisition was 100,000 rand of sub, and I should probably make these amounts equal because we're working in Excel. That's 10,000 rand and not 100,000 rand. Sorry about that. And then the retained earnings were 50,000 rand. So So this is what happened at acquisition. Obviously at CTA level, at this point, this is where your revaluations at acquisition will occur. Let's, yeah, we don't need to go into that stuff, but I'm just giving a basic example. And then what you do after this is you say equal sum, and then you get 150,000. And then here you're going to take equals that times 0.8 is what you have at acquisition. This is what the parent is entitled to, and then the non-controlling interest is basically the total less this 120,000, which gives you 30,000 rand. The next step is to make the non-controlling interest, the NCI rather, at fair value was 40,000 rand. Now this tells you that to bring NCI at fair value, you had to basically add 10,000 rand and we actually subtract that 10,000 rand from the at acquisition. So that brings our at acquisition to 110,000 rand. Okay. Excel is always not such a nice thing to work with. And then we purchased, parent purchase sub for 140,000 rand. So this brings the goodwill to 30,000 rand. So if they had purchased for less than this amount, it was going to be bargain purchase, but in this case we've got a goodwill. Then you need to analyze what happened since acquisition, and in this case you just look at the retained earnings. So retained earnings, to look at what has happened since acquisition, we basically stand at the beginning of our current year. We're busy doing the year ended 31 December 2019, and we said that the opening balance is going to be 100,000 for retained earnings. So we go back and we actually say equals 100,000 rand less the retained earnings at beginning, and that gives you 50,000 rand. And then this 50,000 rand, we analyze it to make it 80%, and then you get 40,000 rand, meaning that your NCI is 10,000 rand. Then you need to analyze what has happened in the current year. Now in the current year, P, profit for the year, was 120,000 rand. Now this is going to be affected by the inventory, by the intergroup transaction of the inventory that sub sold to P. When the sub sells to the parent, it affects the analysis. So I think to make for this to make sense, let's actually start to do our journals, and then we go back to the analysis. Sometimes you just have to play around with everything. Group statements are very involving. So let's do journal 1 is going to be our main elimination journal. This is quite simple. It's going to be share capital, debit that with it's going to be 100,000. Retained earnings I'm just gonna make this so that we go fast. It's going to be 50,000 Rand. NCI is created at fair value 40,000 Rand. Our investment will be a credit because we're trying to eliminate, we're actually reversing. So what the parent would have done is they would have debited the investment, which is 140,000 Rand, but they are supposed to now eliminate that investment to reverse. So with consolidations, all you're doing is reversing things so that they don't appear in the group statements. The group statements are supposed to be consolidated, and they're not supposed to show double effects of what is actually happening between the two companies. And then our goodwill was 30,000 Rand. And then by just looking at this journal, sometimes in most cases this journal is very like long. I always add up the credit side and the debit side, and they should always balance. And here you've got 180,000, and this side also 180,000. That shows you that it is balancing. Then there's a journal in this step. Let's just call it journal 2. This journal usually goes like debit retained earnings 10,000 Rand and credit NCI 10,000 Rand. And obviously don't forget, you always show what statements each of these legs affect. I'm just not gonna do that now because then this video would be like very long. Now to go to the intergroup transaction, let's just open again. Inventory sales between sub and parent were 90,000 Rand. Sometimes it's so easy to forget. I know we last did these things in undergrad, but I actually find that all these notes affect me when I'm doing the CTA stuff. We tend to easily forget that these journals need to be done, and that these journals affect our consolidated statements. Again, this is just to reverse the intergroup sales. Normally sales are credited, but in this case we do the opposite. We debit sales, we credit cost of sales. And then in my example, I'm just gonna do a calculation and here on the side and call it, I don't know, calculation 1. Let's just call it C1. And in the parents closing inventory, there's inventory of 50,000 Rand, which was purchased from the sub at 20% on cost. I always write cost price plus gross profit equals selling price. So I always do this so that I can remember that cost price is 100 and gross profit is 20% and selling price is 120. Cost price is the one that's 100 because our gross profit is 20% on cost. If it was 20% on sales or on or 20% profit margin, then selling price would have been 100, because the 50,000 Rand that is in closing inventory is considered the selling price. And I'll put that in inverted marks because it's the amount that the parent purchased from the sub. For the sub, that amount is selling price, but for the parent it's cost price. That's why we then divide by 120 and multiply. Oops, sorry about that. I'm just gonna put this in brackets. And multiply this by 20. and that gives us this amount. So you already have journal 4, which is going to be debit cost of sales with 833 and credit inventory with 833. And then don't forget the tax effect, which is basically just debit deferred tax, and you times by 28% and you get 233. Now that we're done with this, we come back to our analysis, and in the current year, profit for the year is going to be affected by journal 4 and journal 5. And I'm just gonna make it one calculation. Remember, the subs profit for the year is 120,000. So I'll say equals 120,000. Cost of sales decreases profit, and then we're going to say plus the income tax effect. It's gonna have the opposite effect, but it's basically a thing of, if your expenses increase, they actually decrease your profit. However, it decreases your tax, and that tax decreasing in a way is seen as profit increasing. That is basically how that's how I make sense of that. I hope I'm making sense. Something happened in my formula. Oh, I put 12,000 instead of 120,000, my bad. And then we say equals this amount times 0.8, and then this NCI column is going to be basically that less that, and then we get 22,800. And in this 22,800, guys, there's a journal for this, and it's so easy to actually forget these things, but there is marks for this at CTA level. I promise, if they ask for all the consolidation journals, there is marks for getting this journal. It's just basically going to be NCI, P&L, because sometimes you forget which one gets debited. 22,800 is going to be NCI SFP. And then the dividends paid. So this is what the dividends that the sub paid, and that was 20,000 rand. Let me just double check. Sub declared and paid dividends of 20,000 rand. I'm gonna put 20,000 rand here and multiplied by 0.8, that's 16,000. And then 4,000 minus 4,000 for NCI. And then this is it. This is the analysis done and dusted. And don't forget the dividends journal. It's a lot to think about with. Now, dividends received are always credited. Remember, income is credited, but because this is consolidation, we need to reverse this. The parent can't put in the consolidated comprehensive income, the consolidated statement of comprehensive income. The parent cannot say that they received 16,000 rand dividends from their sub. Okay, that's not how you do a consolidation journal. So that's why it gets reversed. And then NCI gets debited. Oopsie. My keypad keeps on locking. It keeps on going to num lock. Sorry, guys. And then this is going to be dividends paid. 20,000 rand. this is now like all our consolidation journals. Here's our analysis. Now let's draft the consolidated statement of changes in equity. I'm just gonna put borders, all borders around this. See. There we go. I want to put share capital column, retained earnings, NCI, and then this is the total, but sometimes they don't ask it and it's not really important. You just total everything up. You do your opening balance, your total comprehensive income, profit for the year, other comprehensive income, dividends paid, and closing balance. So the parents in the share capital column, we're just gonna show the parents share capital, and it didn't change, so all of that is going to be 0. This column is usually like this unless the parent issued shares during the year, right? Retained earnings opening balance is always the parent's opening balance plus the opening balance in the analysis, which is this 40,000 rand, and had they been bargain purchased, you would also include it there. So in our case, it's equal to 200,000 rand plus 40,000 rand, which is in our analysis, and you get 240,000 rand. Here's the parents' opening balance at 1 January 2019 at 200,000, as I had said. The profit for the year is going to be parents' profit for the year plus this profit for the year. Remember this, sometimes I prefer to take this amount from my consolidated statement of comprehensive income. However, this is a very basic example, so there is no need to do that. But I think if in a complicated scenario, it's best to take the amount that comes from the consolidated statement of comprehensive income. So our parents' profit of the year was 250,000. Let me just double. My camera has stopped recording, guys. So profit for the year is 250,000. The parents' profit for the year plus in this amount from the analysis, 91,200 less dividends received of 16,000 rand. Then dividends paid in the retained earnings column is the ones that the parent paid and declared, which was 30,000 rand, and that's going to be negative 30,000 rand. And then your balance is basically equals all of this, and then that's what you get. And then in the NCI column, you literally jot down everything from the NCI column. This 40,000 and that 10,000 constitutes your opening balance for your non-controlling interest, and this profit for the year goes under the non-controlling interest in your consolidated statement of changes in equity. And this 4,000 dividends paid, literally that's how you know. So I find this is why one of the reasons why I find the analysis method so much easier, because I know once I've done my analysis, I've pretty much calculated everything. This is definitely why it's my preferred method. And just like that, you're done with your consolidated statement of changes in equity. Next up, I'm pretty much done. I'm just gonna, when you do the consolidated statement of comprehensive income, all you need to remember is, do I have a sub at year end? If I have a sub at year end, I'm going to basically add all of the parents' income, right? And the sub's income, but taking into consideration your journals. When you do this, this is not asked a lot in at CTA level, so I'm not gonna focus on it because in your sales, under sales, you have to add the parent sales, add the sub sales, but then you have to subtract these sales, and the same thing goes for cost of sales. This inventory leg journal actually affects your inventory in your consolidated statement of financial position. So does this deferred tax. It's basically all about this is a credit inventory, so in your SFP you subtract that. This is debit deferred tax, so this is a deferred tax asset. And all of just it's all, it will be all about taking into consideration your consolidated journals as well. And then the SFP, these amounts you literally take to your consolidated financial statement. And also, it's quite important to remember that goodwill is a non-current asset. This is something I forget. So that would help you when you're drafting your consolidated statement of financial position. I don't think there's a need for me to go into so much detail about how to do that. Also considering that they don't ask the easy things. So I have never seen it, but you never know. It's always good practice to do it on your own, but doing the analysis and the journals pretty much does everything for you. So once you do this, you shouldn't struggle to do the consolidated statement of comprehensive income as well as the consolidated like for instance, I'll just do just like a short extract, consolidated statement of comprehensive income. So let's say for the sales, um let's say for the sales amount, P already had 60,000 rand, right? And the sub had 25,000 rand. Well, okay, perhaps that's a bad example. Let's say P had 600,000 rand and the sub had 250,000 rand. And then we're going to look at our journals and have to subtract that 90,000 rand intergroup sales. And then that would be the consolidated sales. So you just keep doing the same for all the items that are in their consolidated statement of comprehensive income. Yeah, guys, if you want me to do as examples where the parent loses control, so disposal of a sub, entire disposal of a sub, IFRS 10 B98, please drop a comment in the comment section below. I will do it in another video, and as well as step acquisitions and associates. Yeah, I think group statements are easy if we remember all our basics. This was just a basic example, but I think I'm also happy to do this. This also like helps me to feel a bit more confident that I know my basics, so I'll be a bit more confident about attacking the scary stuff. Thank you for joining. I love you for watching. Leave a comment, drop a like, tell me what you'd like, let me know what you would like to watch next. Do you want to see how does the consolidated statement of changes equity change in a situation where a sub is acquired during the year, a sub is sold during the year? It gets very complicated. And if you want me to do a group statements example when group statements meet IS 21, I will gladly do that for you guys, because I think in that case then you really need to know the analysis method, because those calculations can get quite tricky. Thank you for watching. Drop a like, a comment. Bye.